Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. It's the weekend, so let's quickly recap the action and set up the next open. This past week started choppy and cautious, then ripped higher into Friday after the Supreme Court knocked out a big chunk of the tariff program. The S&P finished the week just under 6,900 and the NASDAQ led the charge. But here's the tension. While equities were partying into the close, bonds were already reaching for protection, yields sliding back toward the lows from earlier this year. Then over the weekend, the story flipped again. Fresh tariff headlines are back in the stack. So Monday isn't really about Friday's strong close. It's about one thing: can that relief rally actually survive another policy curveball? On the weekly time frame, the tape looks like a recovery week that found its footing and then finished strong, especially in the S&P and the NASDAQ off that late week catalyst. The S&P 500 was up about 1.1% on the week, the NASDAQ up about 1.5%. The Dow was more muted, and small caps just didn't really confirm the move, and that divergence matters. It says this wasn't some broad melt-up, this was leadership-driven. Now layer on rates. Yields drifting down is classic growth scare, safety bid behavior. So the bullish read from the equity charts comes with a big asterisk as we head into the weekend. Staying on the weekly view, the clearest message was rotation. Money moved into offense, communication services, consumer discretionary, industrials, plus financials and tech. Defensives like staples and utilities, they got hit. That's the market briefly pricing a release valve, fewer tariff headwinds, less near-term drag, and a green light to lean back into growth and cyclicals. The warning is in the concentration. When leadership is this selective, it can reverse fast if the macro headline stack flips, especially with bonds already leaning cautious. Into the weekend, the market's biggest risk is simple: headline gap risk. The developing story from multiple outlets is that after Friday's court setback, the administration may pursue a new, across-the-board 15% tariff under a different mechanism, with timing talked about as soon as Tuesday. That's not confirmed policy yet, but the headline alone can swing futures. Then add geopolitics. Oil was already firm on US-Iran tension, and higher energy is exactly how inflation anxiety sneaks back into the tape. And crypto isn't calming anything down. Bitcoin around 67,600 and Ether around 1,952 are both softer into Sunday, with traders tying the dip to tariff uncertainty. Heading into Monday's open, the playbook is straightforward. Watch the gap, watch rates, and watch whether leadership stays in mega-cap quality or flips hard back to defense. First stock to watch next week, NVDA. This is the main event. Earnings hit Wednesday, February 25th, and the market has basically centered its AI risk budget around this one print. If NVIDIA guides strong, it can reignite the NASDAQ leadership we just saw into this week's close. But if it disappoints, or if tariffs push yields or risk sentiment the wrong way, NVIDIA can turn into the unwind trigger for the entire AI complex. Heading into the next open, watch how NVIDIA trades on any tariff gap. That's your tell on whether traders still want AI beta or they're cutting exposure first. Apple is your cleanest, real-time tariff proxy. This past week, it joined the mega-cap rebound as traders priced tariff relief into Friday's close. But heading into the next open, Apple becomes the tell. Are markets repricing supply chain risk and margin pressure, or treating the weekend tariff chatter as pure negotiating theater? If Apple breaks down early on Monday, that's usually not just Apple. That's the market saying policy risk is back across global consumer tech. CRWV is a different kind of AI trade. AI infrastructure plus funding sensitivity. Next week, CRWV reports earnings on Thursday, February 26th after the close, and it's already carrying financing worries in the story. That's why it mattered this past week. It sits right at the intersection of AI excitement and the cost of capital. If bonds keep flashing caution and policy headlines revive inflation fears, high beta AI infrastructure names are usually the first to feel it. Heading into the next open, watch whether CRWV stabilizes or starts slipping, because that's often an early warning on liquidity and risk appetite. Exxon is your macro cross-check. This past week, energy held a bid as geopolitics and US-Iran tension supported oil. Heading into the next open, Exxon matters because oil is the input that can reintroduce inflation fear, even if growth is cooling. If the market gaps down on tariff headlines and Exxon is up, that's your classic defensive rotation signal. If oil fades and Exxon can't hold, it says the tension premium is cooling off, and the market may lean back into risk, as long as tariffs don't escalate further. SMCI is your AI hardware stress test. Even with the broader market stabilizing into this week's close, SMCI stayed under pressure. That's the market getting picky inside the AI supply chain. And that matters into the next open. If tariffs and weekend headlines push traders into de-risk mode, these high-beta, levered names usually accelerate lower first. If SMCI can't bounce even when futures stabilize, it's a signal the market only wants AI exposure in higher-quality megacaps, especially with NVDA earnings right around the corner. Looking to the next open and the week ahead, treat this as a risk management calendar. Monday morning, we get Fed speak from Waller. He can move rate expectations fast, especially with yields already leaning lower. Tuesday brings consumer confidence and regional manufacturing, both key for the so-called growth scare debate. Friday's PPI and core PPI are the inflation narrative test, especially if tariffs and oil are both in play. On earnings, Wednesday is NVIDIA, Thursday is CRWV, and together they can whip the AI complex around. Big picture. If policy headlines stay loud, markets will trade gaps and reactions, not careful forecasts. To wrap it up, looking back at the past week, stocks finished strong on a tariff relief catalyst and a clear rotation into offense. But the cross-asset message stayed cautious, with bonds signaling protection and oil keeping inflation risk in the mix. Over the weekend, tariff headlines moved back into focus, which means Monday's open could be all about gaps. Not slow, gradual moves. So get some rest, have your levels ready, and stay flexible. This is a market where the narrative can flip before the bell even rings. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.